Hello, welcome to iSectors fourth quarter 2024 fixed income model review video. My name is John Koch, iSectors Chief Investment Officer, and I am joined by the CEO of iSectors, Vern Sumnicht. Today, we'll go through a quick rundown of our fixed income models and the bond market as a whole as we see it here in early 2025. So, last year in 2024, all three of iSectors' dedicated fixed income models beat the Bloomberg Aggregate Bond Index. And all three of them have different investment philosophies. So capital preservation is a short-term, high-quality bond ETF portfolio. Domestic fixed income is our core bond model built with ETF bond ladders in a slightly wider duration band to take advantage of the changing interest rate environment. And global fixed income is a slightly longer duration model with exposure to international and emerging market bonds. So all three of these bond models with different strategies easily beat the Bloomberg Ag in 2024. And they all, since their inceptions, have beat their corresponding benchmarks as well.
Net of fees.
Net of fees, correct. Yep. And you see the net line is the dotted line here for each of our models in gold. So capital preservation is benchmarked against the Bloomberg 1 to 3 year government credit index, which is a similar duration profile to our capital preservation model. It's outperformed gross and net since 2010. The iSectors domestic fixed income allocation is benchmarked to the Bloomberg Ag that we showed earlier. It's outperformed since 2009 with much less volatility, as you can see here with the red line of the Ag swinging above and below our model in gold all throughout this period from 2009 until now. Global fixed income is in the same boat. It's benchmarked against the FTSE World Government Bond Index, and it's also outperformed with much less volatility since 2009. And so how is it that these three models of ours have all beat the Ag in 2024 and have all beat their passive index-based benchmarks since inception? Well, to us, the story is that bond indices such as the Bloomberg Aggregate Bond Index are not the best investment vehicles. You need to be careful investing in products based around those indices. The first reason that we see right now that stands out to us is that they do not provide proper diversification against stocks, specifically the Bloomberg Aggregate Bond Index shown here. This chart shows the rolling 36-month correlation between the S&P 500, represented by the SPY ETF, and the Aggregate Bond Index, represented by the AGG ETF. You can see right around the time COVID started in early 2020, delineated by the red line here, the correlation between stocks and bonds has steadily increased, almost up to a 0.8 correlation now. That's about as high as stocks and bonds have ever been correlated in history. So when stocks go down, recently bonds have gone down as well. And the worst part about that is that unfortunately, on the other end of the spectrum, when stocks go up, bonds are not going up with stocks either. So this graph shows the performance since 2020 of the Bloomberg Ag in dark blue at the bottom, the S&P 500 in green, and then we're showing gold as well as an alternative diversifier in a portfolio just to compare performance over this period. And as you can see, the Bloomberg Ag has struggled since 2020, negative 13.62% cumulative returns in that period, while stocks have risen almost 90% and gold has been about 80%, just short of stocks. While at the same time, gold has had a low correlation to stocks during this period, as you can see by the blue and green line zigzagging a bit there. The Aggregate Bond Index has kind of given you the worst of both worlds, high correlation to stocks and negative performance since 2020.
John, maybe the lesson here, there's a lot of reasons. We're showing a few of them, but the bottom line is the concept of an S&P 500 aggregate bond, like 60-40, allocation for a client portfolio is truly broken. I mean, the bond side of the portfolio partially because of inflation, partially because of this higher correlation, partially because of higher government debt, which increases the allocation to government bonds in the aggregate bond index. But for a number of reasons, that 60/40 concept is broken. And clients need to be, or investors, advisors for their clients need to be very careful about how they're allocating the portfolios, and especially how they're allocating the hedge of the stock market, and be focused on the simple use of an aggregate bond index is not what it used to be prior to maybe 2020. I
Exactly,
think you
Vern.
have some more you wanted to show about that,
Yeah,
right?
well, it works perfectly. You mentioned the high amount of uh, debt that the government has issued, the U.S. government has issued, and that's the final problem we have with the Bloomberg Aggregate Bond Indexes in general, I suppose, here that we want to point out. This shows the top issuers of the AG as represented by the AGG ETF from iShares. 40% plus of the model of that ETF is allocated to United States government bonds. And that's because they issue the most debt. The way that bond indices work, they weight the companies, the constituents that issue the most debt with the highest weighting. So this is the aggregate bond index, but if you were to invest in a corporate bond index, index-based product, and index-based ETF, they would be allocating the heaviest to companies with the most debt. And to us, that's just not a prudent way to invest in fixed income, in our opinion. So if you have any questions about our fixed income models, we have other models that could potentially help diversify a portfolio. Don't hesitate to call us. Here's our contact information. And here's a disclosure page for you to inspect carefully. Thank you. Have a nice day.